NXP Semiconductor, a global semi company, offers a broad range of semi and related services, mainly to the automotive industry. So it makes semis mainly for the car industry. Financial performance. The net income margin has taken an absolute beating. I mean, Thanos in heaven, this is just really bad. So yeah, the margins have really taken a beating. I mean, they've been going downhill faster than a Prince Andrew interview. Uh, but the deterioration, can be summed up by increase in competition. It does operate in that sector of the market with tight margins as well as difficult, intense competition is normal, as well as COVID, which has just made things worse. Now, costs have either been decreasing or increasing at a decreasing rate. Right now, this is as a response to the difficult operating conditions. So you're not gonna really spend that much on cost when you're really not growing revenue and when your margins actually at zero. So yeah, difficult operating environment has really taken a hit on profitability. The R&D, you can see, is slightly below the R&D as a percentage of revenue, slightly below the industry average. At an average of about 19, the industry average is about 20%. So it's slightly below the industry average. Not too concerning, given that it's not too far behind the industry standard. However, the negative revenue just highlights the loss of market share, which is caused by increased competition, as well as the deteriorating market conditions caused by COVID. Wow, COVID just really made a difficult, bad situation even worse. The decline in the net income at the 101%, just highlights and follows a trend of loosening of declining sales, increasing competition, COVID hampering the supply chain. So, the profitability overall of NXP Semiconductors has just been really poor. Um, the ROE, you really don't expect much from it, considering margins are just horrible and declining, and the return on equity just follows that trend. It's really awful, but understandable considering NXP is not really making any money. It's actually losing. So, but let's see the financial position. I mean, the financial performance has been horrible, absolutely horrid. So hopefully the balance sheet is attractive enough. So the current ratio's performance, underwhelming compared to industry average. Industry average is about 2.37. On average, NXP's current ratio is about 1.84, so very disappointing there. The ratio, however, has been improved from 2018, 2019, and 2020. Okay, that's a good performance. Um, so it's really not a bad thing when you consider that NXP is really not making any money. It's actually losing money. It has just an absolute no margins, losing in terms of profitability and market share, but it's still improving its balance sheet. So that's pretty good. That's pretty good. The asset test, same thing. The market is in absolute decay, but the balance sheet is still liquid enough. It's still below the industry average. Industry average for the asset test is about 1.88, but it's been improving, considering that the market is in disarray. The balance sheet is at least liquid. It does not have a significant heightened liquidity risk. That's good. So both performances are worrying, but considering that, both performances of the asset test and the current ratio are a bit worrying. But considering where the margin is and considering the fact that it has been growing, not that bad. All right, now the debt to equity ratio of NXP keeping the industry base for a bit, I'll get there, but the debt to equity ratio is below the industry average. Industry average is about 126% and NXP is at 111. Now there has been a significant increase. Now this increase follows the fact that NXP is really not making any money. Looking at the declining margins, declining sales, declining net income, is not making any money. So as a result, it's kind of borrowing a bit to show up and strengthen its balance sheet. And the increase in the debt to equity explains, so the increase in debt basically explains the good performance of my liquidity ratios. So you're bolstering your liquidity. So NXP has been bolstering its liquidity in response to the fact that it's really been performing horribly. Difficult market condition, COVID making a worse situation even worse. So, all right, so they have been improving debt, increasing debt to improve liquidity. Not a bad thing considering that overall, on average, the ratio is still below the industry average. All right, not bad. So, not an increased financial risk. It's actually a good use of debt just to strengthen your balance sheet. Give yourself a strong performance to actually compete and survive and weather the difficult trading environment, the difficult, operating environment. So very, very good there. Um, the balance sheet is still positive, low-ish liquidity risk, not increased financial risk considering that the debt to equity is below the industry average. So, all right, overall, one can live with that. The inventory days are below the industry average. The industry average is about just over 101 days. On average, NXP's inventory days are sitting at 96 days, just over 96 days. So overall good, it paints a good picture of liquidity, shows that NXP is not holding on for um, still holding on to inventory for way longer than it needs to, and you can see it has been improving. It is a good thing considering margins are tight and margins are under pressure. So, it is selling what it can sell, not making way more than what is needed, and probably putting unnecessary pressure and burden on margins. So, very good. The inventory days just support a good liquidity position that this balance sheet is in. It's not that attractive, but the balance sheet is at least good. Now, the cash position. The cash margin portrays a worrying image of a company that which is declining a bit in its ability to generate cash. Um, so a bit of a worrying picture. Good rebound in 2020 from 2019. 2020, the decline, the rot was at least stopped. Um, Overall, the ratio is above the industry average. However, the cash flow from operations margin, the cash margins, they are a bit worrying, considering, you know, COVID is really wreaking havoc on this company, on NXP, as well as the difficult uh, market conditions. So it is good. I mean, it's above the industry average, 32%, but just worries me. So the sufficiency of cash flow is below the industry average of 0.84, which when you read with the declining margins, it really makes me a bit nervous. I mean, yes, in 2020 the rot was stopped, but still, the cash position just makes me a bit nervous. I mean, don't get me wrong, NXP's business model can generate cash from operations, which is good. It does generate cash from operations, and it does, at the end of the day, have cash available, to fund all operating activities. But it is worrying a bit, like when I consider the fact that it's not selling as much as it should. Revenues are in decline. Yeah, revenues are in decline, not really making any money. A bit worrying for me. A bit worried. So You know, it's operating in difficult environment. COVID is wreaking havoc on it. Yeah, I'm a, this company makes me a bit nervous. So the total return yield has dramatically reduced. So what NXP returns to shareholders has been dramatically reduced, and that makes sense. The market conditions are worsening and it's finding itself in a very, very difficult position. It's not going to pay as much return, as much to shareholders as it would have in the good old days. And the PE ratio is totally insane. It makes no sense. It is crazy. It is beyond expensive. That is just a ludicrous PE ratio in my view. So look, overall, good liquidity, but horrible financial performance. The cash burn is a bit worrying. Now, the only reason, you know, shareholders are probably, investors are sticking with this company, considering it has such a ridiculous PE ratio, is, well, mainly because it does pay out quite a lot. It does return quite a lot to shareholders. But to me, nah, it's a no-no for me. It's too expensive, operating in a very difficult market, and it's really, really, really struggling.